All right, so Chapter 10, Property Acquisition and Cost Recovery. I know most of you this week are concentrating and maybe stressing out over writing your research paper. So I know it looks like Chapter 10 and 11 is a lot to cover, but I'm actually going to cover not very much in Chapter 11. Just going to talk about like-kind exchanges. 1231 property we're going to leave to the next class, the taxation of business entities. So it's a pretty short discussion. Here, cost recovery and property acquisition, it's pretty similar, not exactly the same as you hopefully learned in financial accounting. But actually, this if you're familiar with how you deal with capital assets and the cost recovery, depreciation, amortization, depletion, and financial accounting, this should be somewhat of a breeze for you. So let's start. And so just like with financial accounting, businesses must capitalize the cost of assets with a useful life of more than 1 year on the balance sheet rather than expense the cost immediately. For most capital assets or assets, this cost recovery is done through depreciation. When you have intangible assets, it's going to be called amortization. And then when you have things like natural resources, you're going to recover your costs through this thing called depletion. Businesses use these methods to recover cost of assets due to wear, tear, and obsolescence of the assets. So, same general concept as in financial accounting that you should have learned. So here's your different methods, depends on the type of property you have. And under depreciation, you have both tangible, personal, and real property. Now, if you recall, in financial accounting, the one real property that we don't depreciate is land, but the buildings and improvements on the land we do depreciate. Now, the first concept, and this is very similar to what we've already discussed, you have to determine the basis of the property that you're going to depreciate. And you have to recoup the cost once you've acquired these assets. And just like with financial accounting, when you do this cost recovery, primarily depreciation, over time, the book value goes down on that asset. Well, the same goes for our basis. As you depreciate, the basis, just like book value of that asset, goes down in amount. So it reduces the basis. And so what is the basis of an asset? Well, if it's acquired, the basis is your cost. And then as you go along and depreciate over time, the basis is the original cost minus whatever accumulated depreciation you have up to that point. So we have an example here. We have a scrapbooking retail chain purchasing an old office building for $175,000. An additional $15,000 was spent painting and remodeling the building in preparation for its opening. 2 years later, an employee discovers that several leaks in the roof were causing serious water damage to the store's inventory. The company spent $50,000 to re-roof the building. Every 6 months, Scrappy Happy pays $500 to have the carpet professionally cleaned. Well, certainly the original cost plus the fixer-uppers, the $15,000 plus the $50,000 to re-roof, are considered capital expenditures because you're receiving a benefit over 12 months. Now, the $500 carpet cleaning is an expense, not a capital expenditure. So, question is, what is the original basis of the building, and what effects do the other two transactions have on the original basis? Well, the original basis is $190,000, the $175,000 plus the painting and remodeling, and to the $190,000, you're going to add the $50,000, but you're not going to add the $500 expense. Expense that immediately. And so anyway, personal and real property, the cost recovery method is depreciation, intangible assets, such as goodwill, patents, copyrights, trademarks are amortized, and then natural resources are depleted. Now, if you recall, for depreciation, under the financial accounting, what you had to do is you had, and let's just talk straight line, but because it's the easiest to talk about, what did you have to determine to figure out depreciation for a particular accounting period? Well, you had to figure out let's say you just bought the item, okay? You know what the cost is. It's the purchase price. And to figure out your depreciation expense, what you have to figure out is, under the straight line method, you have to figure out salvage value and reduce the cost by the salvage value, because that's money you're going to get back. And you're going to divide the cost minus salvage value into the estimated useful life of that asset. Well, here, under the current depreciation scheme under tax laws, what we have is something called the Modified Accelerated Cost Recovery System, which makes it much easier to figure out depreciation expense for a certain tax period, because the useful life is determined for you. And in general, it's 5 years or 7 years for most personal property, and then For real property, depending on the use, you're going to have more years, but we'll talk about that as we go along. But anyway, under Mackers and this RevProc 87-56, it lays out what kind of asset it is, what the life of the asset is, and even gives you the depreciation percentage that you use in any particular year of the asset. And so to compute Maker's depreciation for an asset, you have to know the asset's original cost. You have to know its depreciation method. There are 3 methods. There is the double declining balance. It's just like what you learned or should have learned in financial accounting. You have your 150% method, and then you have your straight line method. Most companies prefer to use the double declining balance method because it allows that company to recover the costs of the asset more quickly. And it also reduces their tax expense. The taxpayer must also know the recovery period or depreciable life. Again, you go to the tables, there in Exhibit 10-3 and 10-4, you'll see what the tables are for specific kinds of personal property assets. And then last but not least, you have to know the applicable depreciation convention. Mostly this affects the amount of and the percentage that you can deduct in the year of acquisition and the year of disposition. So we'll look at that as well. So you have to know those 4 things to figure out how much depreciation expense you take on an asset in a particular tax period, tax year. All right, so personal property depreciation includes all tangible properties such as computers, automobiles, furniture, machinery and equipment that are other than real property. Note that personal property and personal use property are not the same. If it's personal use property, car we drive for only personal use, not business, we don't depreciate. Your house is personal use property, you don't depreciate it. Well, it's not even personal property, but a machine you use, let's say a copier and a computer you use for your personal use, is not personal. Well, it's personal use property. Yeah, it's personal property, but it's not depreciable personal property, I guess is what I'm trying to say. It's only when you're using this in a trade or business. All right, so there's your 3 acceptable methods of depreciation. And what they note here is that for financial accounting purposes, an asset recovery period is based on its taxpayer-determined estimated useful life. We talked about that. For tax purposes, they give it to you. In RevProc 87-56, an asset's recovery period is predetermined by the IRS. It saves the taxpayers time and, figuring out this stuff. Of course, there's less chance of a taxpayer doing mischief by or manipulating the numbers, you might say, because there's no room for manipulation here. So once the business has determined the appropriate categories for its assets, it can use the revenue procedure to identify the current recovery period for all assets in a particular period. Back to depreciation method, the three methods. As a taxpayer, and this includes businesses and self-employed people here, but it might include investment in real estate rental property. If they acquire certain assets and again, we're talking depreciation of personal property right now, but kind of the same general concepts apply to depreciation of real property. Let's say that a company purchases certain types of assets. Some of those in a particular tax year, and some of those assets are of the same kind, machinery. What they can do is they can lump all that machinery together that are purchased within that year and determine the depreciation method that they want to use for that class of assets. So they just lump them together. It makes it easier to depreciate. And so they can elect to use one of the three methods for that group of assets. The other thing to note about depreciation method is that, let's say they do purchase certain assets that are same or similar machinery in a particular year. They could elect to, for instance, depreciate those assets they just purchased on a straight line basis, even though they have other machinery that they purchased in prior years that they're depreciating on, let's say, a double declining balance method. Okay? So it's an election they make for classes, the similar classes of assets in a particular year. So you've got some flexibility, at least from that standpoint as well. All right, for most personal property assets, you're going to have a recovery period, or useful life, if you will, of either 5 or 7 years. So look at what we have here in the middle, and then they just kind of make it easier to look at by summing things up under this category. Cars, light, general purpose trucks, and computers and peripheral equipment have a recovery period of 5 years. And note that if you use the 200% double declining balance method, what you do is you use double declining balance method up to the time that, and this the taxpayer has to figure out, until the time that they would depreciate more using the straight line method, and then at that time they start using the straight line method. Same goes for the 7-year recovery period. The type of assets you have there are office furniture, fixtures, and the biggies are machinery and equipment. Now notice machinery could, include some fairly large, anywhere from a forklift up to one of those big digger trucks if you're in, let's say, highway construction. All right, as far as, and remember, this is one of the 3 things you have to determine. You have to determine the basis. You have to determine the depreciation method you want to use. You have to determine the recovery period, which is given to you in Rev Proc 87-56. And next, you have to figure out the convention. For most assets, most taxpayers, they're going to use a half-year convention. Now this half-year convention affects the amount of depreciation that they take in the year of acquisition and the year of disposition. Most taxpayers are going to use the half-year convention. We'll talk a little bit about mid-quarter convention, but not too much. I'll explain to you why they have both a half-year convention and a mid-quarter convention as well. So half-year convention just means that the taxpayer takes 1/2 of a year's depreciation in the first year of the asset's life and 1/2 year's depreciation in the last year of an asset's life. And so the IRS depreciation tables, which I refer you to page 40, 10-40 is where that starts. There you have in table 1 your Macker's half-year convention. And so what you have to do, you have to just look at the type of recovery period you have, and for a particular personal property asset, figure out the year, and it gives you the depreciation rate. Note, if an asset is disposed of before it is fully depreciated, only 1/2 of the table's applicable depreciation percentage is allowed in the year of disposition. So, for instance, let's say you have a forklift. So you've got a 7-year useful life for a forklift. And let's say in year 4, you dispose of it. And so looking at table 1, what you would depreciate is exactly 1/2 of 12.49% of the asset for that year of disposition. Note, that's true whether you dispose of it in January of that 4th year or December of that 4th year, or somewhere in between those dates. Now, I don't want to spend too much time on the mid-quarter, but the reason why they put this mid-quarter convention in here is because taxpayers were figuring out that, well, we can wait until the end of the year, December, and purchase a bunch of assets and get a half year's worth of depreciation in that first year, even though we've only had the asset for less than 30 days. And so the IRS, to thwart this effort, created this mid-quarter convention. And so if you purchase more than 40% of your assets in that last quarter, you have to use this mid-quarter convention, which certainly is going to be less depreciation expense allowed for the taxpayer than would be a half-year convention. So that's why you have this mid-quarter convention. I don't really expect. I expect you to know the 40% rule, and I expect you to know why they have this rule. But other than that, I wouldn't worry too much about these steps, because you don't really need to know that, at least right now. And so in calculating depreciation for personal property, locate the applicable table provided for in RevProc 87 they say 57, but I think it's 56. Let me make sure. Oh, I've been saving 85. Yeah, 8757. All right, 8756 it is. I guess that's the continuation of the discussion of what they started in 8756. Okay, so look up the applicable table provided for in RevProc 8757. I don't expect you to know these numbers. I mean, it's, you know, tax professionals who know should not be expected to know all the sections of the IRS. I mean, should they know Section 61 and what that is? Yeah, that's kind of important, because it defines income. So, you know, I would expect one to know that, especially a tax expert, tax practitioner. But for the most part, I mean, you know, spewing out IRS, Internal Revenue Code section numbers doesn't impress me, nor RevProc numbers or things like that. It's just, you know, if that's what you're doing, is learning these sections and numbers and what they pertain to, you don't lead a very interesting life, and nobody's going to want to hear code section numbers at a cocktail party. It's just not very interesting conversation. So, not important for you to learn, even if you do this as a professional. So, look at the applicable table, select the column that corresponds with the asset recovery period, find the row identifying the year of the asset's recovery period, and then apply the half year, and in some cases, if applicable, the mid-quarter convention, which we're not going to worry about. All right, moving to real property, the recovery period depends on the type of property and its use. And again, you've got two categories. You've got residential real property. Now, again, this does not apply to a personal use resident. What this applies to is what? Well, rental homes and apartments and condominiums and, townhomes. For those types of assets, you have a recovery period of 27 and a half years. And the main one, this next category, is the following. Non-residential property placed in service on or after 1993. I mean, might you have some non-residential property placed in service before May 13, 1993? Well, yeah, because it's not been 31 and a half years yet, but let's face it, most of you are going to face the non-residential property placed in service on or after May 13, 1993, because that was what, 23 years ago, almost. So for non-residential property placed in service on or after May 13, 1993, you have a recovery period of 39 years. So pretty simple figuring out that type of depreciation. See if there's anything else I want to talk about. Recall that land is real property, but it's not depreciable real property. Well, they give an example here. I'll get to what I was going to say in just a minute. So we got a warehouse that's purchased. Oh, I was going to say, what's non-residential real property? Well, it's things such as a warehouse. I mean, I'm sure there are other things, but the main one would be a warehouse. And this company purchases the warehouse and the land it resides on for $170,000. Well, we know that land is not depreciable, so you have to figure out the market value, how much of that purchase price should be allocated to building and how much it should be allocated to the land. That may require an appraisal. But anyway, they purchase both the warehouse and the land for $170,000, and they allocate $120,000 of it to the building and $50,000 to the land. And so you simply take your $120,000 and you're going to depreciate that over 39 years. And so, again, if you go to the tables, let's see, what you have to figure out, if you go to page 43, table 5, down at the bottom, you have to figure out the month the property's placed in service. In this case, it is July. So you go to 7, and in year 1, it shows 1.177. So you take 120,000, the amount allocated to the building, and multiply that by this 1.177 to come up with $1,412 Okay, so that's how that works. All right, so that's enough for real property. That's pretty easy, huh? Note here, under section 179, told you I wasn't going to talk about code sections, but this is another code section you might want to know. Under section 179 of the Internal Revenue Code, section 179 allows for immediate expensing of the acquisition of certain capital assets, both personal property and real property. Well, what does this do? Well, if you immediately expense rather than just capitalize and use the cost recovery method, that's going to lower your tax bill in the year of acquisition. Now, note here that you can't have a loss. You can't generate a loss through using the 179 immediately expense. So you may have to depreciate part of an asset. Let's say you purchase an asset for $300,000 and you only have operating income for the year of $200,000. Well, you're going to only be able to immediately expense up to $200,000, and you're going to have to depreciate the balance of $100,000 over the recovery period, whatever the designated recovery period is. The other thing that's good about 179 is it's elective. You can elect to immediately expense all, part, or even none of it immediately. So there's some room for flexibility here. All right, I think that's enough of that. Amortization. For intangible assets, businesses recover cost of the asset through amortization. Intangible assets in the form of capitalized expenditures such as capitalized research and development expenses, or research and experimentation costs, do not have physical characteristics. And so the different types of intangible assets you can have are categorized as either Section 197 intangibles. That's usually those patents, copyrights, trademarks, that sort of thing. Well, actually, what that is, 197 is actually when you purchase, let's say you purchase You didn't produce the patent. You did not develop the patent. You simply purchased the patent from someone else. That's a Section 197 intangible. Another type of intangible asset is startup expenditures and organizational costs. We'll talk about that in a second. Research and experimentation costs, and then patents and copyrights that you develop in-house yourself. And so for purchased intangibles, these assets have a recovery period of 180 months, which is 15 years, regardless of their actual life. For organizational expenses and startup costs, well, what is an organizational expenditure? It's the expenditures to form and organize a business in the form of a corporation or partnership. It typically includes cost of organizational meetings, state fees. There's a cost to incorporate. You have to apply and pay a fee with the state that you plan to be incorporated in. And this is true even for LLCs and certain types of partnerships. Accounting service costs, incident to the organization of the business, and legal service expenditures such as document drafting, taking minutes of organizational meetings, and creating terms of the original stock certificates. And so these are costs that are incurred to start up a business. They're incurred prior to starting the business. And so what you get to do is, and this again is elective, you can immediately expense up to $50,000 of those costs, or excuse me, $5,000 of those costs. Okay? So immediate expense up to $5,000 of the organization expenditures or startup costs. There's a limit on this. If the business incurs more than $50,000 in organizational expenditures or startup costs, there's a phase out of the $5,000 immediate expense. So let's say that, for example, the startup costs are $53,000. What amount does the organization get to immediately expense? Well, it's 53 minus 50, so you have to, it's basically 5,000 minus 53, or yeah, 53,000 minus 50,000 in brackets, the last two numbers. And so they're only able to deduct in that first year of operation $2,000. Now the other 51,000, what do they do with that organizational or startup cost? Well, what they have to do is amortize that $51,000 over 180 months. So their first year's amortization would be the $2,000 immediate deduction, immediate expensing, plus 51,000, whatever the number is, 51,000 times 180, and then you'd have to figure out how many months there are in that particular year that apply. So, you know, this may have happened at the beginning of the year. It would be 51,000 times 180 times 12 months. If it's, you know, in the middle of the year, 6 months, you know. So, anyway, that's the way that works. Now, research and experimentation expenditures, again, you're trying to develop new products, and so these are the costs that go into developing new products. Businesses may immediately expense these costs, or they may elect to capitalize and amortize these costs using straight-line method over a period of not less than 60 months, beginning in the month benefits are first derived from the research. Patents and copyrights. Whether or not you can amortize these depends on the way the business purchases or develops the patent or copyright. Well, what they're trying to say there is it depends on whether they purchase the copyright or patent or they developed it in-house, which I've already kind of said. If it's purchased within in-house, essentially what you do is you amortize the cost or basis of the self-created intangible assets over the shorter of the legal life. For instance, patents have a legal life, I believe, of 17 years, or the remaining useful life. So if, let's say, you develop a patent in-house, if the useful life of the patent is 30 years, but the legal life is 17 years, you would have to amortize it over 17 years, not 30 years. Let's say it only has a 10-year useful life. Well, the 10 years is the lesser of the legal life or the useful life, so you'd have to amortize over 10 years in that case. If you directly purchase a patent or copyright, you amortize the cost over the remaining life of the patent or the copyright. So there's kind of the summary of those things. Depletion, you know, that's what you do with natural resources. Not a big thing to know. I guess maybe if you're in the forest industry, you might need to know that sort of stuff.